Well, good afternoon. My name is Eric Levinson with VinaCapital, and we're here on Wednesday, January 10th for our 2024 outlook. So 2023 was another interesting year. Actually, the market finished up and GDP rebounded quite nicely, but how we got there was not necessarily a straight line. And so what we're going to do today, in the beginning, I'll review kind of what we got right, what we got wrong, what we missed, and then I'll introduce our chief economist, Michael Kokolari, who will share his views on the macro economics for Vietnam. And then our head of research, Lin Vu, will cover the market. And then once they're done with their prepared comments, well, then the three of us will come back on stage for a Q&A session with everybody. So if you do have questions, please type them into the chat function. I'll have the iPad. I'll be able to view your questions while we're doing the panel. So how were our forecasts for last year? So what did we get right? Well, and I say we, it's really Michael, but it's the research team as well. Modest inflation. Inflation finished the year roughly a little bit above 3%, so quite manageable. Large trade surplus. Now that's kind of almost counterintuitive. It actually means that exports suffered, which is why we had such a large trade surplus. And Michael will speak to this. Manufacturing production was weak. Again, slower on the export side is something that we thought would happen. Stock market finished higher in 2022. We did forecast that. And last year, the market was up 12.2% in local terms and 9.3% in USD terms. Now, in terms of what we it wasn't really right, wasn't really wrong, more of a yellow light, weaker domestic consumption. We thought it would be weak. It turned out that it was actually even weaker than we thought. Weaker GDP growth, again, we thought it would be weak. It was even weaker than we thought originally. And then last, infrastructure spending. This was somewhere between a yellow and a green. It actually still picked up pace, and there was significant infrastructure spending in Vietnam, but certainly not maybe as much as we thought. Now, what did we miss? So there were a couple of things that we got wrong. VND did not appreciate. It depreciated about 2.9%. Stock market volatility. We did think the market would be, up and down, but I think what we didn't necessarily forecast was the magnitude of the volatility, particularly month to month. There were a couple of months in the first quarter and certainly September, October, where there were just kind of wild gyrations. And even though the fundamentals didn't change, there was some significant month-to-month volatility. And then last but not least, on the tourism side, was very interesting. Tourism, as Michael will speak about in a bit, actually rebounded very, very well, with the exception of Chinese tourists, who do make up about a third of the tourist kind of legacy before COVID. Now, what didn't we foresee? Vietnam-U.S. Comprehensive Strategic Partnership. Now, this was announced in September when President Biden visited Vietnam. And this is a huge, huge deal that has the ability to transform foreign direct investment in Vietnam. And this will be really important in the coming years, not just in the next 6 to 12 months. Significant net foreign outflows from the equity market, totaling almost $1 billion. So the fact the market was up 12% in local terms and over 9% in USD terms with significant foreign outflows is actually pretty promising and pretty optimistic. And then lastly, and again, this is another positive, is that within the SSC and the Ministry of Finance, there's open discussions and a lot of transparency regarding the government's desire to move the Vietnam equity market from frontier to emerging market status. And so we've been, along with other asset managers in Vietnam and other institutional investors, working with the SSC, and it's been very, very encouraging to hear leadership at the federal level and at the ministries talk about a specific timeline, talk about some specific goals that they have. And so as Michael and Lynn talk about their comments, this will come up, and certainly we usually get questions in the Q&A about the upgrade as well. Now, importantly, how's performance? Because that's really what people care about. Pleased to say that everything that we did, again, we continue to outperform. We continue to beat our benchmarks. VOF, our London-listed closed-end fund, finished the year 2023, and this is compound return at 17.2% USD versus the index at 11.2%. Again, 3-year, 5-year, significantly outperforming the index. VVF, which is our Luxembourg UCITS fund, last year was up 14% versus simple return, 9.3 for the index. Again, 3-year, 9.3 versus negative 0.9. 5-year, roughly 10% versus 3.9. Inception, 9.8 versus 5.6. And then VAF, which is our Cayman feeder, that feeds into a local fund, helps bypass foreign ownership limits. Last year finished the year at 22.9 versus 9.3, 3-year at 12.7, 5-year at 13.1. VAF feeds into VSAF, which tends to have more small and mid-cap names as well. Now on the local side, VEOF, which is primarily mid and large, was up 19.5 versus 12.2. Again, 3-year, 5-year outperforming. VSAF, as I mentioned earlier, tends to have a lot of small and mid-cap names, up almost 31% versus 12.2. 3-year number at 18 versus 0.8, just really fantastic performance. VIBF, which is our balanced fund, half equities, half fixed income, finished the year at 11.2 versus 9.2. That's a blended benchmark equity and debt. 3-year 10.4 versus 3.2. And last but not least is our fixed income fund, VFF. Finished the year at 8% versus 6.4. And again, the reason we show all of these, and some of you care more about the international, some care about the domestic, is the research team we have, the portfolio management team that we have, each of them delivers outstanding returns. It's not about having one star manager or one sector that's driving performance. When people look at our platform, what they see is consistency and our ability to deliver alpha, both in up markets and in down markets. And I think 2023, which was a volatile year, we maintained our ability to deliver alpha for our clients in all of our funds. And so very, very proud of that. Now with that, let me introduce our chief economist, Michael Kokolari. Michael's no stranger to the audience, and he will give a very, very clear view on what the economy will be like for 2024. So Michael, thank you, sir.
Thank you, Eric. Okay, so Vietnam's GDP growth fell from 8% in 2022 down to about 5% last year, which is a pretty big drop. Now, part of the drop came from the fact that in 2022, we had this post-COVID reopening boom. So the 8% figure was pumped up a little bit by that. But that having been said, the economy in Vietnam was pretty weak last year, particularly in the beginning of the year when GDP growth was around 3 to 4%. There were two things that really weighed on Vietnam's economy last year. The first thing is that there was a collapse in manufacturing and exports. And the second factor that weighed on the economy last year was that the spending and sentiment of local consumers was quite weak. Now, part of that was because there were layoffs in FDI factories, particularly in the beginning of last year. That gets back to what I just mentioned about the collapse of manufacturing and exports. But the sentiment of local spenders, consumers, was weak from had other few things that were weighing on it. Partly there was there's an ongoing slowdown in the real estate market that we'll talk a bit more about. Interest rates were quite high. You know, if you have a mortgage and your mortgage payment was quite high, you had less money to spend on consumption things. So there was a couple different factors that were weighing on consumer sentiment last year. What we expect for this year is a big recovery in manufacturing. In fact, manufacturing has already bottomed and started to recover and will accelerate as the year progresses. We'll show some slides on that. And what we also expect is a recovery in consumption. Consumption has also bottomed out. There, the recovery is a bit more modest than in manufacturing. It's like really sharp and sharp rebound. And with consumption, it's kind of a bit of a more modest recovery, although I do think that will accelerate as the year progresses. And the last thing to mention is that the economy got some help from government fiscal stimulus and policies last year. And I think we will, again, get some help this year that we'll talk a bit more about. Now, my key projections for this year, first of all, GDP going up to 6.5%. In these key projection tables, those that have watched these webinars before, I always like to circle kind of where the action is happening. And here the action is really happening around manufacturing and exports, as I mentioned before. The other thing that I have on this table, though, is I've put the Vietnam dong. And I've said that I think this year the value of the dong is going to be fairly stable. And the reason why I have that on this chart is because those of you that follow Vietnam will know that we had a very big increase in interest rates and then a decline in interest rates, all within a fairly narrow period of time, about 18 months. This surge and then subsequent decline was related to the value of the Vietnam Dong and Vietnam Dong depreciation pressures on the Dong. This year, we think that the Dong is going to be much more stable, and therefore interest rates will be much more stable. That will help support the economy because, as you can see, and this is a bit just kind of common sense, when you have a surge in interest rates, naturally the demand for loans goes down. So that's one of the reasons that credit growth went down at that time. And then now when interest rates have come back down to, below the levels where before we had this surge, now we're having a recovery in credit growth. And that will help to support the economy in a variety of ways. Just the last point on this topic, I just alluded to the fact that the Vietnam Dong was part of what was behind this surge in interest rates. And you can see that here. This is when you had a big depreciation in the value of the Dong. Remember that this is the Vietnam Dong US dollar exchange rate. Remember that the way it works for exchange rates is when the line goes up, it means the value of your currency goes down. So here was really the point in which the State Bank of Vietnam had started to really pump up interest rates. And so again, we expect much more stable value of the currency this year and therefore more stable interest rates. So that is an important side story. The main story is the manufacturing and the consumption, but this is also part of the reason why we expect faster GDP growth this year. But again, the two main things are manufacturing and consumption. So let me get a bit more into the details on those. You can see here that we have a real kind of strong recovery in exports. Exports have already bottomed out and it's already starting to recover. And remember that in Vietnam, exports and manufacturing are kind of two sides of the same coin because most of the stuff we make here we export. And also recall, for those of you that perhaps were watching this particular webinar at this time last year, that what happened with this exports and manufacturing story is that here, this is back in 2022, US companies ordered a lot of stuff when they had the supply chain disruptions. This is a whole part of the whole COVID story. So the inventories of those US firms got way too high. And that's the reason that this year in 2023, last year, 2023, firms like Walmart, Target, et cetera, really slashed their export orders. Those of you that follow Vietnam may remember or recall that at this time, when we had this webinar last year, we were literally the only ones that were talking about that 2023 would be a big down year for manufacturing and export. So things have really kind of playing out the way that we expected in that. And what's driving this recovery is a recovery in the demand for consumer electronics and for PCs. This is the first thing. In other words, Vietnam exports, different products, and so different things are kind of going at different rates. And the first thing that has already turned is the computers exports, which you can see over here. Our computer exports have bottomed and have already started taking off again. That is in line with what's happening in the global market for laptop computers and PCs. So basically during COVID, there was a big surge. People were at home. Post-COVID, a big drop. And part of what's driving this recovery for laptop computers is people are upgrading because of AI. They want to get a higher spec machine. But the important thing from a Vietnam point of view is, it's flipped. It's already turned in the world, and so therefore it's turned in Vietnam. That having been said, our garment and smartphone exports have not flipped yet. And here's an interesting slide that I'll show you, and I'll give the credit to Standard Chartered for this observation, which I thought was really, really interesting, I noticed. And what they've observed is that in Asia, because the things we're talking about here, these are Asia-wide phenomenon. And so they observe that in Asia, you can see from this red line here, that what will happen in Asia is that first tech exports either bottom out or top out on, when rolling over, and that leads what happens with non-tech exports, so the overall exports. So this is exactly what we expect in Vietnam. Laptop computers and consumer electronics are recovering, and this should lead to recovery in the rest of our exports. And the last thing I'm going to say on this topic, I know I'm beating this to death a little bit, but remember that in Vietnam, exports are 80+% of GDP. So this is actually a really important topic. And the last thing I want to mention, this is a very important leading indicator for what we expect to happen for the rest of this year, is that these are imports of the components that are used to make laptop computers, cell phones, et cetera. And the imports of electronics components by FDI companies, as you can see, this is sort of the middle of the year in 2023, it's really, really taken off. And so what that means is that these FDI companies, Apple, Canon, Panasonic, et cetera, they're importing a lot of the components that they need to make consumer electronics products, and they're doing it because they know that their order books, are really robust, and that they're going to. So this is a really reliable indicator, leading indicator, that we have an ongoing acceleration in manufacturing and exports for the rest of this year. Okay, so that's the export story, manufacturing. And I mentioned that the other big thing going on is that we're having now a modest recovery in consumer the spending and sentiment. And part of what's going on there is that we had factory layoffs in the beginning of last year. And according to the government's own numbers, the factories have kind of more or less rehired all the people that they laid off. And that was from around Q3, so that's helped to build the sentiment. And the other thing that's going on is I mentioned that part of the thing that was weighing on people's sentiment was the slowness in the real estate market. We have recently started to see some signs of thawing in the real estate market. I actually published a report about that a few weeks ago if anyone wants to know the details about that. But that thawing, which is partly because interest rates have come down, is helping to make people's sentiment feel better. And you can see that, as I mentioned earlier, the export and manufacturing story is sort of sharp down and sharp up. And here, it's kind of a more gradual recovery that's going on. But it is a recovery, and we expect that to keep going as this year progresses. One of the positive developments that we're hoping for and looking forward to is the government the National Assembly of Vietnam will hold a meeting within, I believe it's next week, and they're going to try to address some of the issues that have been impeding real estate development. And so if they're able to solve some of those issues, that will thaw the real estate market even more, that will help fuel people's consumer sentiment more. So that's one of the things we're hopeful about. When you look into the geeky details of the government's own financial forecasts, they themselves are forecasting tax revenues that are related to new real estate projects to really take off this year. And so they kind of know what they have in mind for trying to make things easier in the real estate market. The other thing we also notice in the government's own financial projections is that we had a pretty good increase in infrastructure spending last year, and they kind of seem to be more or less projecting a comparable level this year. So not a further increase, but a pretty high level. It was about $25 billion plus last year. So that would be a good number. And so that's another thing. There's a few other government measures. There were some things going on with the VAT tax cut. This is not so important. That having been said, we could get an increase in salaries of government workers that would represent a bit of stimulus into the market, into the economy. So these are the things that we're keeping our eyes on here. And the next topic I want to come to is this whole story about FDI in Vietnam. And this is a topic that we bring up in pretty much all of our webinars and all of our reports. So people may start to feel bored that we always come back to this topic over and over. But the thing is, the story of FDI in Vietnam is just so amazing and compelling at a level that I'm very interested in economic history. And what we have happening in Vietnam is just really not unprecedented in modern history. There's something similar in China, but not the same magnitude. Normally, what we always talk about is that Vietnam is very appealing for FDI investors because of the quality of the workforce. The wages are low, the quality of workforce is high, and we have the good geographic proximity to the supply chains in Asia. And that's all always true. But over the last 2 years, we have begun to focus more and more talking about how Vietnam is really a winner in the emerging geopolitical landscape of how the world is sort of shaping up. You have this sort of China-BRICS block over here, and then this sort of US-French-Korean block over here. And Vietnam is unique. They have this idea they call bamboo diplomacy, which is, Vietnam's sort of rooted. They know, what their values are and who they are. But they're happy to sway and get the economic benefit from being both friends with China and both friends with the US. And that's reflected in this headline that it's really being actively courted by both China and the US. This is captured in this headline. And the other thing that's been going on in Vietnam is that the quality of the FDI and the complexity of the products that we make just keeps getting better and better every year. In 2022, Apple announced that it would make the iWatch in Vietnam, which is the most complicated product that's ever been made here. And then last year, we've got this new announcement that they're actually going to move some R&D activity here. So as those of you that have seen some of my work in the past, I've showed this smile thing before, where you see like going up the value chain to produce more and more complicated products or activities related to manufacturing. Things like marketing and R&D is more complicated. And the other thing that I have mentioned in the past is some research from Harvard and others that the most powerful economic driver for a country like Vietnam is to produce more and more complicated products, or to do more and more complicated activities in manufacturing of those kind of products. And so here you go. Here's another step in that direction. And the last point on this slide is that we had, again, another really impressive FDI figure last year. The commitments, which is kind of mainly the planned FDI, really surged last year. 9% of GDP. This is an incredible number. FDI in China never really got much above 4 or 5% of GDP. So, and this is, again, mainly a forward-looking number. So it's a good leading indicator of the money that will come into the country in the years ahead. This is a really neat chart that I found, which is, we have discussed before the idea that Vietnam benefits from like the U.S. friendshoring and, relationship with different countries, good relations with different countries in the world. This chart, let me explain it a bit because it's really makes a really good argument for Vietnam. The bottom line is FDI flows between countries that are geographically close. So this is things like Mexico and U.S., this nearshoring that's going on. And so that's been steadily going up, as you would expect it would. If you're geographically close, rich countries investing in their neighbors. But the red line is investments between countries that are geopolitically close or have good relations. And you can see here that having good relations is even more important driver for FDI flows than being geographically close. To me, this graph is like kind of very stunning. And so Vietnam, remember, we're friends with the US, we're in the friendshoring, and we have China's now kind of courting us for they have their own reasons for doing that. And so we're really benefiting from what's going on with this red line here. The last topic that I want to talk about is we have this year the implementation of this new tax system, the Global Minimum Tax, GMT. And I know that there are some investors, some people, particularly, I would have to say, particularly here in Vietnam, domestically, there are a lot of people that are concerned that the GMT would somehow impede FDI flows coming to Vietnam. And this is completely wrong. Doesn't make any sense, and I'm going to try to explain briefly why that is. For those of you that don't know the details, tax rates for multinationals will go up to, ostensibly will go up to 15% in a whole range. I mean, there's countries all over the world that are implementing this system now. Now, previously, if you were an FDI, a multinational company that wanted to set up in Vietnam, the main reason that you came here is because of what I mentioned before, the workforce, ease of doing business, infrastructure, things like that. That's how multinationals decide where they're going to invest in emerging markets. That having been said, governments, offered around the world, not just in Vietnam, but they offered additional tax incentives to try to get the multinationals to come here. So some companies, like reportedly Samsung and others, pay tax rates as low as 5%. So for those guys, their tax rate's going to go from 5% to 15%. So, there's people, particularly here in Vietnam, that are saying, oh my God, if the tax rate's going to go up that much, that's going to be the end of people, companies investing in Vietnam. Well, first of all, the average tax rate of multinationals is probably closer to around 10 or 11%. So there were a few companies that got really good breaks, but on average, the breaks were not as good as that. That's one thing. The second thing is that Vietnam, like most of its peer countries, are coming up with different ways that they can essentially rebate some of the additional tax burden back to the companies, offering them subsidized R&D, subsidized training expenses, maybe infrastructure, things like that. And this is this is happening in countries around the region. So let's just pause there and think about what I said so far. So put yourself in the position of a decision maker who's in the US or in London or something like that, and you're deciding, you want to set up a factory, and you say, well, I was going to set up a factory in Vietnam, but now that they've raised the tax rate to 15%, I'm not going to do that anymore. I'll set up a factory instead in Thailand where the tax rate will be 15%. Well, that's stupid. They're obviously not going to do that. So that's the first way that you can see that GMT is not going to impede the FDI flows. And the other thing that I want to point out is that, when, as I mentioned before, there's research about this, that when companies decide where to invest, the first priority is looking at things like workforce, infrastructure, et cetera, in emerging markets, because there's big differences between the quality of the workforce, the quality of the infrastructure in different, EM countries. But when you think about it, if a company is deciding, do they want to invest in, let's say, Ireland or in the US, well, now it's a bit of a different story because the quality of the workforce is basically the same. In fact, English language competency in Ireland is probably even better. My mom's Irish. The infrastructure is basically the same. Easy to do, so everything is basically the same. So if everything's the same, now you care a lot about the tax rate. And now let's talk about Ireland, which will have a big problem from GMT, which is that in 2014, Apple paid tax rate of about 1% in Ireland, but they paid about 26% in the US. So there, the implementation GMT will have a big difference on the FDI inflows. I'm beating this topic to death a little bit because it is a surprising topic that a lot of people in Vietnam in particular are very, very uncertain about and worried that it's going to impede the FDI inflows. I'm reminded a bit about the trade war. When the trade war first came out, I think I was the only one that was saying, no, this is eventually going to be good for Vietnam. I don't think GMT will necessarily be good for Vietnam, but it will be neutral and possibly even slightly positive. So that's a really important topic. Don't be dissuaded when you hear arguments about that. The FDI story in Vietnam still looks fabulous and on a long-term horizon. And again, the conclusion of everything that I wanted to say is that this year, we do expect GDP growth to rebound from 5 to 6.5, and that's mainly because of improvements in manufacturing and in consumer sentiment. Okay. Now what I'm going to do is I'm going to turn it over to our head of research, Lin Vu, who's going to talk about the implications of everything that I said for the stock market and for the selection of the different stocks and sectors that we look at. So, okay, Lin, thank you. Here you go.
Let's take a quick look at how the VN index was doing in 2023. Despite of growing at a modest rate of 12%, VN index was indeed the best index performance among ASEAN members. Among the sectors, the brokers was the best performing sectors, increasing 95% over the year. For example, SSI gained 90%. VCI also gained 80% during the year. The second place is information technology with 46.7% gained, led by FPT with 45% gained. Materials is also strong, gained 46% with Huafat, and GVR and DGCs all gaining more than 50%. From the bottom end of the charts, consumer staple, real estate and utilities was the laggards. Consumer staples was dragged by Masan, Sabeco, and Vinamilk. Real estate was dragged by Vinhomes, and the utilities was dragged by gas. How is the earnings outlook this year look like? We see an improving trend in earnings growth over the quarters. In the first quarter last year, it was a minus 13.5%, then it was a minus 8%, then flat, and then end up the year with an expected growth of 32% in Q4. Looking forward to 2024, we estimate growth of our coverage, which accounts for 95% of the VN index by market cap, to grow 13% year on year. We think the market generally is on the right track. Business activities will gradually recover in the first half and grow better in the second half of 2024. As an active fund manager, all our funds are having an expected earnings growth higher than the market on average, but also having a lower valuation than the market average. Take VVF as an example. VVF 2024 EPS growth is expecting to be 25% versus 13% on the average of the market, and the valuations of VVF forward-looking is at 8 times versus the markets of 10 times. Let's break down to see which sectors will have the best earnings growth and most attractive valuation this year, with market rate dropping to 11.6% on average, and take-up rates in new projects improve significantly. We expect earnings growth of real estate developers under our coverage, excluding group families, to double in 2024 from a low base last year. We also expect material sectors to grow around 50% year on year. And brokers and consumer could grow more than 30% this year. Given a strong growth of several sectors, PEG level in 2024, many sectors look very attractive. Some are having the PEG lower than 0.5 times PEG for 2024. If classifying into the themes, there are several factors we think will benefit from the current dynamics. Not just in Vietnam, global technology, data services, AI are doing well. So we remain to have high conviction on these sectors with a sustainable growth of 20 to 25% per year in the next 3 to 4 years. Benefiting from benign interest rate environments, we like banking, brokerage, and real estate, including industrial real estate. Vietnam is still in the need of infrastructure development with accelerated government spending in infrastructure. We expect that these sectors will benefit this year with many mega projects being kickstarted. On consumer demand recovery for domestic and global, we see retail and post logistics is attractive. We think those sectors will perform particularly well in the later part of the year when demand proved to be improved more vividly. Energy is a new sector that we add this year due to expected higher oil price, and also the final investment decision, FID of Block B Omon, is expecting to be approved in the first half of this year. Then is the market cheap? The market is cheap right now. Valuation is priced at near crisis level despite of decent earnings outlook and improving macro condition of Vietnam. As you can see on the left-hand side charts, this chart here, there are only 2 times in the past 10 years that we reached the low valuation level. The first time we briefly touched because of COVID and COVID outbreak. And because of the various factors, Vietnam right now is trading as a steep discount compared to regional peers right now as 30% in terms of PE compared to ASEAN's members. Another way that we look at how attractive the stock market is to compare the earning yield with the current 12-month deposit rates. As the average 12-month deposit rates right now had dipped to below 5% level, lowest level in the past 10 years, and the forward PE right now is at 10 times. The gap between the earning yield and the deposit rates has been widening. This say the same thing. It means that the stock market in particular is very attractive to invest in compared to the deposit rates if you look at the past 10 years. Going to 2024, there are certain headwinds that we think still persist. Geopolitical uncertainties, the latest developments with Red Sea attacks also cause some of the uncertainties. The risk of El Nino on agriculture outputs and prices, and also on the external demand with the risk of China growth slowing in the second half of this year, possibility of a US recession, and also the risk of domestic demand to be improved slower than our expectation. But there are many catalysts for the market's growth this year. As you can see, the government remains supportive stance on both monetary and fiscal policies. We also have the KIX system, which is expecting to go live in the first quarter of this year. One event that many of us has been waiting for so long is that Vietnam could be included in emerging market index. And in official review in September this year, there's a very high hope that Vietnam will be included. New regulations on property markets is also important because it can speed up the legal process for many projects, and we have 3 main laws to be approved and take effect from 2025. And then last but not least, Fed may start cutting rates this year. That's good to reduce the pressure on the currency for VND. As the banking sector is accounting for 37% of the VN index. So take a quick look at the banking outlook for this year. We expect earnings growth for the banking stocks under our coverage this year to grow by 18% from 7% last year. Where are the growths are coming from? Banking sector will see higher credit growth as 15% in 2024. Expected to be led by loans to real estate developers, along with a recovery in manufacturing and mortgages. NIM is likely to stay flat or recover slightly from the trough due to credit demand recovering. Better growth in retail lendings with higher yields and higher CASA ratio as well. In terms of assets quality, we think it's continued to be improved following improved macroeconomy, lower lending rates, and the real estate market is expecting to recover this year. The system credit growth last year were weak until Q1, yet picked up strong in Q4 with the fastest jump in December. Credit growth for the full year was at 13.5%, higher than our forecast of 12%. For 2024, the system credit growth target was set at 15%, with all quotas already be assigned to banks right at the beginning of the year. We are quite confident that the banking system can reach 15% level this year, supported by the macro recovery prospect and higher lending to manufacturing and real estate sector. For the interest rates, after a strong pickup in 2022, rates now have declined by 3% to even below pre-COVID level. Lending rate cuts was even faster due to weaker credit demand. For 2024, we don't expect a major shift in accommodative monetary stance, so we expect lending rate to reach the bottom in Q2 this year and stay low for the rest of the year. In terms of valuation, the banking sector overall is trading at 1.5 standard deviation below 5 years mean and 1 standard deviation below 10 years mean, which is very attractive in our view, given an earning growth of 18-20%. As you can see in this chart, some banks are trading at below 2 standard deviation below 10 years means, such as Vietcombank, ACB, HD Bank, and TP Bank. Now let's take a quick look at the real estate markets because we expect a certain turnaround in the real estate markets this year. As mentioned earlier, local banks have aggressively cut the interest rate to align with the government message to support the economy in general and real estate market in particular. Most of the state-owned banks already bring the mortgage rates back to pre-COVID level, while we are still waiting for some smaller banks to cut mortgage rate further in 2024. We all know about the incident happened in 2022. By then, various ministries, including the Ministry of Finance, the State Banks of Vietnam, and other agencies, has been tasked with identifying fresh solutions to boost the bond and real estate markets. Revised housing laws and revised real estate laws was approved last year. A very important law, land law, is expected to be approved in the first half of this year, which will set ground for a better land valuation process. Investment law, which were issued in 2020, which caused certain conflicts with other real estate laws. We think with the throughout revision of all of the related laws, this will help solve one of the most hectic problems for real estate developers. That is the legal process for project approval. And it will help fasten development cycle of a project, meaning better cash flows. And buyers can legally own their homes with a red or pink book. In terms of fundings, as mentioned before, there's various ways the government is trying to support the real estate developers by developing more transparent and more sustainable bond markets through credit programs for social housing, loan restructuring, and also lower interest rate. We believe that this will bring us to a new cycle for a real estate sector. We start to see the sector being warmed up with more transactions and high take-up rates in new project launches from late last year. We see there's a lot of similarities between the growth in 2014 and now. Interest rates have coming down meaningfully, improving macro backdrop, and many new laws has been approved in 2014 and now too. However, unlike the previous cycle, we don't expect the real estate price to go up crazily, at least in the next 1 to 2 years. But we expect a steady and more stable growth, with some real estate developers under our coverage right now, given a low base of last year and expected good pre-sales number this year, we think that earnings growth could be double this year. So this is the end of my presentation. We're now open for Q&A.
Well, and thank you. We are back, and Lynn, that was your first webinar with us, and I think you did great. Now, I do want to make, I guess, I don't know if it's an announcement. To Win, please join us. So during Michael's presentation, he received some news, and he had to leave immediately. Many of you know Tu Win. Tu is our head of listed investments. She's responsible for our local and offshore listed funds. So she's going to join us for Q&A. She was in the back of the room, so very fortunate that she's here. Andy Ho, our chief investment officer, is traveling, so otherwise he would have been here with us as well. So with that, we'll start with the questions. And if you do have questions, I do have the iPad here, so let me go to the first question from Len. This is probably more for you two. Do you see much first or second order effects from the friend-shoring and multinationals moving production from China? So either one of you.
Yeah, definitely. I mean, either of us can take this question, but we definitely have seen very promising statistics from FDI, registered FDI. So this year, Vietnam's registered FDI has hit the record high level with 32% growth versus the previous year at around $37 billion US. And of this number, if we just look at the FDI from China, that number actually has doubled. So we've seen that names like Foxconn and Goatech, which is part of the Apple supply chain, have come to Vietnam during the year. And they basically have made the long-term commitments to continue and increase that investment over time. So we think that is a very positive trend and definitely the product of our good geopolitical relationship with the countries.
I can probably add a little bit because we talked frequently with the industrial parks developers, and they see very high demand from new investors coming to Vietnam recently, and which is very positive in our view.
All right. Thank you. So here's a question about oil and gas and EVs, and obviously that gets a lot of publicity. So see that we've added oil and gas, a little bit more positive energy. What's our take within Vietnam on the transition to electric vehicles?
I think the transition is taking place, and if you recall, Vingroup has done quite a significant work on promoting EV in Vietnam, not just in Vietnam, but in offshore market as well. We think that is a positive move. Vietnam, together with any like other countries in the region, trying to promote EV, we take it seriously, and I think we will get in there with a big investment from VinFast.
Yeah. Okay. Terrific. And I will say this within Vietnam, it doesn't really have the infrastructure of all of the charging stations that you see in some of the other developed markets. But as we think about the future, very optimistic that that will happen with VinFast getting very much involved in developing that. All right, a couple more questions are coming in, so thank you. So here's one from Eliza. If manufacturing recovering is one of the key strong contributors to Vietnam GDP. Can we please elaborate further on what manufacturing referring to in figures that we can share? And that's a little bit more geared at Michael, but I did want to make sure we address that in terms of manufacturing. Where are you seeing maybe specific rebound this year?
Right. If you look at the manufacturing sector in Vietnam, a lot of that is actually by the FDI investors. And we've observed, and also from Michael's presentation, we've seen that the level of sophistication of Vietnam exports has gone up significantly in recent years, which points to the fact that a lot of this manufacturing is actually in the high-tech manufacturing segment. And that refers to products from the Apple family or Samsung family and so on. In terms of the rebound in manufacturing activities, we think that it's going to be pretty much broad-based because it's stemming from the fact that the level of inventory in the US amongst the retailers as well as the, product retailers like Nike and so on have come down, which means that the demand for imports, the US retailers importing products from Vietnamese manufacturers would go up during the year. And we've seen that the level of inventory from the electronic retailers have also come down. So we believe that this is going to be pretty much broad-based.
Yeah, and one of the things that Michael does along with our analysts is they actually listen to a lot of earnings calls from U.S. retailers. So it's interesting, one of the things that Michael and I were talking about was the earnings report and the transcript from Best Buy. So you wouldn't think that, here we are in Vietnam, which is we're a Vietnam expert, but why are we listening to Best Buy? Because we want to understand what their inventories look like, what their demand is going to be, what their outlook is in terms of replenishing. And so that is another reason why we're bullish. And as Michael talked about earlier, not seeing that bigger rebound in smartphones, but we are seeing that bigger rebound in computers and laptops, things that where really people want to upgrade because of all of the new kind of AI functionality. A couple more questions have come in on real estate. So I may combine a few questions. So here's one that said, have real estate prices in Ho Chi Minh City and Hanoi come down to attractive levels that encourage more demand from retail investors, or will the recovery of real estate be driven mainly by the lower end lending rates? And I'm not sure if that actually, because I think they're linked. Yeah.
So in terms of price, the short answer is not coming down significant.
Yeah.
If there is any distressed assets in prime city, Ho Chi Minh City, Hanoi, when it pop up, it will be taken very fast. Even in prime cities, the land price, I don't think is coming down significantly because it's still the prime area. But in terms of the demand, recently, what we saw recently is that the demand in terms of volume, primary and secondary, has taken up significant. The volume right now in the prime areas has been around 30% of the normal level. And we expect by the end of the year probably get back to 80% of the normal level. There are some certain new projects that launched recently in the past few weeks, and the take-up rate, Privia, for example, is a project of Khang Dien. The take-up rate is 70% after they launch in 3 days. So it's indicating that the demand is still there, very strong. If the project is tackling the right level of the end user.
What I can add is that whatever challenges we have in the real estate market in Vietnam is actually not due to the lack of demand. In other words, the supply-demand balance or mix within Vietnam looks very different from, let's say, China, where there is also another real estate crisis. In Vietnam, it's actually due to the corporate bond crisis and the slowdown in projects approval. The demand has always been there because the family formation in Hanoi and Ho Chi Minh points us to numbers like 30,000 units in each of these large cities in order to accommodate the new families that are formed every year. And in fact, in the last 2 years, we've seen very little supply because of the issues that I mentioned earlier. So the fact is that we are seeing that for projects that are in good location, as Ling pointed out, that the developers were able to launch in the last 12 months have been taken up very strongly. And therefore, I think that But that being said, I do agree that the prices of especially projects that are targeting the high end, for instance, need to come down a little bit in order to attract demand and therefore create revenues for some of the developers.
Yeah. Right before this webinar, so yesterday we published our 2024 outlook. We normally publish a 2 or 3 page piece every couple of weeks. Yesterday's, I think, was 12 or 13 pages. And interestingly, we covered this and we talked about this kind of dueling headlines where you see something that says 70% of a project taken up, and then you see later on that day from the same publication, prices coming down at a certain thing. And so it's important to kind of, I guess, either read the article or maybe consider the source, because the overall health, the demand is still there. And I think it is bad projects, they're going to get knocked down in price, but the good projects aren't. So it's not about the industry, it's more about specific developers, which leads me to a segue of the next question that came in. Are there specific developers that we're more confident in terms of earnings growth? Because it's not going to be everyone's going to win. Are there a couple of companies that you can highlight as these are developers that are targeting the segments appropriately?
I will not name the developer specifically.
You can.
But, but there are the developers that we like that provide medium range products, affordable price, that tackle the right segment. They are doing very well. Even during the bad time, they are gaining the market position. They have gained cash, they are actually doing really good, and then we expect earnings growth of this company to be easily, again I mentioned again, easy to be double this year.
You can mention the company.
Yeah.
Please do, please do. I'm going to put you on the
So
spot.
those are the company we like, with the company with good reputation in providing a clear legal status for all of their projects. Some of the problems in Vietnam is that after buying a home, it takes a very long time for you to be really the owner of the unit that you have. You take long time for you to own the red book or pink book, but for the developers that can be transparent, give you the ownership, then the when trust, basically the trust, because in the past 2 years, the trust was the big issue for the developer actually. It hit the sentiment of investor, and now only the developer that can do well now is the one who has a good reputation in deliver on time and be able to give the right products to the right segment.
You're not going to answer the question then? So
we have a good team.
We'll go to 2 then for the next question. Okay, so, or you, Lynn. So the question here from Tinpab, which is, when do we expect KRX to be fully up and running? And then maybe talk about what that is. So KRX is the new trading system for the stock exchange. So when do we think it will be live? And then what are the benefits?
Right. So there is a lot of expectation that the system should be live this year. I think the deadline was actually last year December, on Christmas Day, but it's been delayed a little bit. But we do hope that it will be live during sometime in the first quarter of this year. The benefit of that is that, of course, I mean, it will accommodate larger volume or larger liquidity for the market, and also accommodate new products, like, for instance, day trading, or some more derivatives products.
And short selling.
Exactly. So I think there's a lot of benefits for having this new system, and one of which is also the fact that I think it will help with the removal of the pre-funding,
yes,
which paves the way for Vietnam to be included in the emerging market index by FTSE Russell.
And so there was a question that came into there as well. And so you mentioned it, and I mentioned at the beginning, which is a lot of transparency around these conversations. Are you optimistic that there will be the upgrade to the secondary market from FTSE?
Right now, the progress is quite positive. FTSE emerging, that primary and secondary. The one we are trying to enter is the secondary, and we will have the final review in September this year. And the key hurdle for inclusion right now is pre-funding removal. And there are multiple solutions to tackle that issue. Basically, the brokers right now have to take the credit, and then they can provide some of the loans for the investors. So somehow we think, overall, we think for the first time ever, there are more light, more hope than before that we could be potentially be including in FTSE index. FTSE is easier than MSCI. At least it's positive for us to be in FTSE first. And if we are included for next year, that will be the official inclusion. This year will be September, just the announcement. But the official inclusion will happen next year.
Okay. And then, as we take a look at other questions here, let me see here. Okay, interesting. How do we evaluate the impact of a potential hard landing or soft landing? And does that, obviously that's not our focus, but we have to be aware of it. How do you think about what that possibility looks like, and how does that help you think about how to adjust the portfolios over time?
Right. Oh, that's a very interesting question. The prospect of the US either in a hard landing or soft landing situation obviously affects the global stock markets and therefore the Vietnamese stock markets. But for us, we are mindful of that from the macro level in the sense that it might also have implications on our exports. And I think we hear from Mike that we're expecting exports to recover this year. Also, I think from Link's earnings forecast for the companies are currently based on the same assumption on the recovery of exports and manufacturing and so on. But we always have our sensitivity analysis built into our forecasts. And of course, it's not clear at this point which direction we are heading towards, but we will be able to adjust our earnings forecast as well as our portfolio positions as we go along, as we observe more information from the US as well as the global macro environment.
Right. Thank you. So here's a question from Pierre. Thank you, Pierre. So please give our views on investment flows into Vietnam. When will foreign investors return? And how will the expected economic conditions drive domestic investor sentiment this year?
And
actually,
I'll
give you 30 seconds to think, because I'll add to this, because there was a separate question about deposit rates in Vietnam being high, and I actually wanted to mention that while they may be high on a relative scale, the 12-month term deposit rate at most banks have come down from roughly 9 or 10% in the fourth quarter of last year. Now they're anywhere from 4.5 to say 5.5, 5.75, and so they've actually come down significantly. And so when we look at the domestic retail market, and we have local mutual funds that we sell here in Vietnam, we're actually very optimistic that people will go into, whether it's the equity market or equity funds, because what they were investing at 8, 9, 10% a year ago is now at 12-month anywhere from 4.5 at Vietcombank to maybe high 5s at some of the smaller private banks. And so we're very encouraged that with interest rates coming down and term deposit rates coming down, that more retail investors will participate in the stock market as their term deposits mature. So now we'll get back to the foreign flow question.
It's very hard to know, the foreign flows, whether and when, how big, and when it will come back to Vietnam. But let's look at it.
Depends how good the call is, I think.
Yeah. Let's look at the reasons why we had a significant outflow last year. So I think it's not just Vietnam, it's over ASEAN. The outflows has been seen across ASEAN. In foreign investors are mainly in Asia. They move to Taiwan. They move to India and Japan. So those are the two markets that attract about more than 20 billion US dollar fund inflow compared to the outflow of ASEAN. So it's like a broad-based outflow, not just for Vietnam. And the second reason is that from Thai, there's some change in Thai regulation for retail investors. But we don't think that is significant in terms of the size of the Thai investor has to sell Vietnam. And for those reasons, we cannot see control and we cannot forecast the outflows, the fund flows of foreign investors. But what we can forecast is the fundamental of the market in Vietnam. And we are very confident that it is a turnaround year from a flat growth. This year growth is strong, and not just strong for certain sectors. It's strong for broad-based. A lot of sectors we are seeing. I saw a question somewhere that whether there are some sectors you don't like. But the thing is, most of the sector more or less have positive. So we have to debate among ourselves, can we have the buy for every sector? That's impossible to have a buy for every sector, right? But right now, it's a broad-based growth across the sector. And the fundamental, as we discussed before, is at 10 years or even more cheap level. It's the only thing we can view right now is that the valuation is cheap, the growth potential is strong. And that will create potential.
I'd like to add that in 2022, when throughout most of the year we had a massive outflow, but in the last 2 months of the year, when the valuation of the stock market hit 10 years low or almost all-time low at around 8 times forward PE, we saw a very large inflow, which means that in a rising interest rates environment, especially in the developed markets like the US, you would think that there'll be an outflow out of EM and FM. But in Vietnam, we did see the foreign flows coming back at a particular point in time when valuation hit like all-time low. So it shows that the foreign investors, while they have global asset allocation in mind, they also are mindful of valuation. And they see the good value of the Vietnam stock market at that point, given that our long-term growth outlook for the country, both on the economy side as well as on corporate earnings side, remains more or less intact. So, I mean, this year, 2024, we are expecting, or consensus points us to a cut of interest rates in the US, which is actually favorable for inflows into EMs and FMs. So with that, as well as the valuation, as well as the fact that Vietnam has the highest earnings growth across Southeast Asia, as well as if you compare China and India, then I think we have a good chance of attracting inflows again.
And I'll just kind of here, I'll just share kind of anecdotally, we're talking to more family offices and asset managers that are looking to allocate to Vietnam either for the first time or for the first time in years based on valuations and moving capital out of places like China where they've had long-time strategic positions or places like India where they may be taking profits or Japan. And so from a personal KPI perspective, I think we're optimistic and certainly the pressure is on. All right, it's a little bit after 5. I'll ask one last question. We won't get to all of them. I've taken pictures of all of them, so if we didn't get to your question, I will be able to ask it. Let me come back here. All right, one last question on banks. So interestingly, the State Bank of Vietnam announced a credit growth, but for the entire system. So normally they kind of do it quarterly. They announced it for the entire system. Does that give you more confidence in banks for 2024, and why do you think they did that?
I think it certainly gives me more confidence, and it's easier for the bank to plan for the whole year. So they give the credits on the first day of the year, and for much higher than that level than we expected for this year. So the banks right now, I think, have a better planning for the full year. First, as we discussed before on the banking outlook, we also expect more loans to manufacturing, more loans to support the real estate sector as well. So those combined together looks very positive. Plus, that will give roughly 18% growth for the banking sector this year. So I think it's really a good signal from the central bank perspective, and also on the view that we think the central bank will maintain accommodative money policy and fiscal policy this year for the whole year to support the economy.
I think it's in the direction of providing more transparency to the system, which is very positive in our view.
Okay. Well, with that, too, I want to say thank you for, on very, very short notice, joining us. Lynn, great job on your first run. And so for everybody, thank you so much for joining us. As I mentioned, I know we did not get to all the questions. I've taken pictures of them, so we'll be able to reach out to you. If you have any follow-up questions, please send me an email. And again, we'll have a replay of this call on our website on Friday or Monday latest. And again, just yesterday, we sent out our 2024 Outlook piece. So thank you so much for your trust, for your support, and we'll see you in April for our next quarterly webinar. Thank you.